June 25th, 2024. My one thought on the day was we might have to trade above this high. The reason for that was if you look the prior day, you can see we had a big spike up, which ended up being a bull trap. And then we got a lower high and, minor lower high here. We ended up getting a lower high here. And you can see the bears, they're trying to form lower highs. You can see they're getting lower lows. So we have a lower low here, lower low here, a lower low here. And we have, like I said, lower high, lower high, lower high. So a couple of lower lows and a couple of lower highs shows you that the market is in a bear channel. And when the market's in a bear channel, it can usually be thought of as a bull flag, the same way this was a bull channel, but ended up becoming a bear flag. So I thought we might have to try and trade above this because the bulls were going to try and force a trading range. The context on the daily chart did not really support, a huge bear trend day and this bear channel continuing. I thought we were going to go more sideways. And if we are going to go more sideways, it's probably going to be a trading range. And if it is going to be a trading range, we will probably trade above this high so that, the bulls can say they traded above this lower high and it's no longer a bear trend. And now we're in a trading range. So I think that's one of the reasons for bar 60 when we got such an explosive breakout to the upside is traders knew that this high was important. And once we got there, the target had been reached. And obviously you get the bear bar closing here, it's low 61. You don't necessarily need, it's important, but if you're long for any reason and you see bar 60, you can just think of it as climactic bull bar, 20 plus bars into a bull or 20-ish bars into a bull trend. Probably going to be a lot of profit taking on the close of 60. Bar 1, a bear bar closing near its low. It's good for the bears. It's possible that we have to trade below yesterday's low. It wasn't a very good reversal bar down yesterday's low on the daily chart. It really isn't all that strong of a reversal. It's probably more of a second leg down. So while we might have to trade below it, if we do, I'm not expecting a ton of sellers down there. There are probably more buyers in this area than there are sellers. Follow through for the bears on bar 2, but a big tail on the bottom and a big tail on the top. So it's really not all that good. You have to keep in mind, when you get a gap up, you should think of it as a bull trend bar. So rather than just thinking of it as a gap, you can just think of it as a bull trend bar that opened here and closed here. And if this is a huge bull trend bar, even though we had, some bearishness here, and this is probably going to get another leg sideways to down, if you get a bull trend bar that's this big, there's probably going to be buyers somewhere in this area if we trade down to it. So this reversal down is probably minor. However, bar 2 is not a very good high one buy. So the bulls, they're hoping that the gap up was strong enough to start a bull trend and that this is a high one buy in the bull trend. The problem with it is that it's a bear bar and traders do not want to buy above a bear bar. So they'd rather wait for more follow through and buy above a bull bar closing near its high. Disappointing 3, big tail on the top. Not all that surprising. We should trade below 2, just considering, just based off the fact that traders who bought above 2 did not, it's not very smart to buy above a bar like 2. So probably more sellers above, hence we should probably trade down here. Bar 4, it's an inside bar and it's a low one short for the bears, but it's not really all that good. You could argue it's a lower high. So 1, and then 3 and 4 would be your inside bar, low one short. So it's a lower high, double top. The bears want to move down, but it's not really all that likely. This to me looks like the start of a second leg. Keep in mind that, most trends start with signal bars or good signal bars. Look here, this is a perfect example. You can see the strongest trend we had today was this, and it started with a pretty good signal bar down here. So the majority of the time, trends are going to start with good signal bars, and bar 4 is not really a very good signal bar. Outside down on bar 5, it's good for the bears. We're probably going a little bit lower. I would imagine we're going below the bar 2 low. But if you think of the gap as a big bull bar. How much lower are we really going to go if that's a big bull bar? Probably not all that much lower. And you have to keep in mind that 1, 2 is the first leg down, and the second leg down could be 4, 5. So this could be forming some sort of second leg trap. When you get those kind of second leg traps, the moves against them can be pretty violent, like exactly what happened on bar 7, where you end up taking a much bigger loss than you probably anticipated you would. It's some follow through for the bears on bar 6, but what's it really doing? It's testing this area. You can see, if this is a big bull bar, we broke out above this high. There should have been sellers above this breakout point because of how strong this was for the bears. So in spots where there should be sellers and they end up getting trapped, if the market's in a trading range, it's going to let those traders out. And you can see we tested the exact high, and that's where we found buyers on bar 6 and bar 7. So the traders who were selling, they were hoping we were going to get a strong close somewhere down here or below this low and, solidify the fact that we're going to get to a new low of the day. Instead, we get something disappointing 6 with the tail on the top. To me, it looks like gap up, bull trend bar, two-legged pullback, and maybe some sort of rally. Bar 7, a huge bull bar. Surprise for the bulls. It's good for the bulls, but I would not buy it. I think that we've had one bull bar. This is the second bull bar, but the only bull bar closing near a tie so far today. The move down from bar 1 to bar 6 was relatively tight, so the channel was decently steep. So it's really not as good as it could be to be buying above 7. Your risk is pretty big. It's not like the most unreasonable thing in the world to buy above a huge bull bar like this, but you have to realize you're probably not going to get the best follow through because the risk has become so big. It's now forcing you to buy high in a trading range open with a really, really wide stop. So you're buying really high, so the probability is not as good as you want it to be, and your risk is huge. So those are both problems for the bulls. And that's why a lot of times there just does not end up being as many buyers above bar 7 as there could be. Something additional to note is bar 6. If you look at bar 6, so what happened here, right? Bad signal bar on this, and we broke out above it and tested back to the breakout point. Bar 6 is a bad signal bar. So bears are going to be willing to sell above this, and they're probably going to be able to scale in and make money. Why? Because this is probably a trading range open. If you're buying up here, you're hoping these traders are trapped, you're kind of more betting on a bull trend from the open. And to me, with how tightly down this channel is, it looks a lot more like a trading range open than it does a bull trend from the open. So while we might rally a little bit higher, maybe go to a new high of the day, I do think we're getting back to the 6 high. And it was interesting because bar 18 did test the 6 high, but it didn't go one tick past it. So that is another reason to think it's possible we might have to test back down to there later today. It's not as necessary because if it's gotten this close, a lot of traders will just take the small loss and buy back their shorts, which can contribute to this buying. But a lot of times it does have to retest that signal bar again. Bar 8, bad follow through. So if you bought above 7, you had a big bar, big risk, buying high in a trading range. What did you want to see on 8? You wanted to see a surprise bar. You wanted to see another bar that looked exactly like 7 consecutive bull bars and hope that we were just going to end up getting some rally, maybe all the way up. We had this gap right here. You're maybe hoping we were going to get up to that low, maybe all the way up to this low. Either way, this low is what I meant to be highlighting, which we ended up closing at the end of the day. But either way, you're hoping for some really strong bull follow through bar on bar 8. Instead, you get a bear bar. So the bulls were not even able to get follow through. They were hoping at the bare minimum they would get a doji bar, a bull doji, or a totally neutral bar, so that the bulls could say at least the bar 7 got follow through and probably is not a trap. But instead, they got a bear bar. So that's really not all that good. However, it is a big enough bar 6, for a second leg sideways to up, and I think that's what bar 9 is. 9 to me looks like possibly a second leg trap from the big bull bar on bar 7. There's a lot of problems with buying up here because if this is going to be a bull trend, why was bar 8 a bear bar so early in the trend? You probably shouldn't be seeing disappointing follow through this early in the trend if you're taking this kind of buy. So a lot of traders are skeptical of bar 9. I don't know if they got 1-to-1 of their true risk. So that's kind of funny. So look at this. So this is a good concept. So you buy above bar 9, or I guess technically the true risk would be from 1 tick above to 1 tick below here. But I don't know. I've just looked at this a lot, and it seems to me that the measured moves are more exact if you don't use the 1 tick above or 1 tick below. But I don't know. So traders had to have their stop probably 1 tick below bar 8, and so their actual risk was to the low of bar 8, and they had to buy up here at the high of bar 7. So the traders who do that and they see the bad follow through on bar 8, what are they thinking? They're thinking, well, that's not what I wanted, and now the market pulled back on me this much. So at one point I was down, 3.5 points. And so the market starts to rally and they think to themselves, well, if I was down 3.5 points at one point, I want to make 3.5 points, since if I had a 60% chance of a second leg sideways to up, and that was the size of the pullback, if I get equidistant to the size of the pullback, then I'll be able to make money. And that could be what was happening where we sold off on bar 13, because it's a 1-to-1 of those two prices. So that could be the reason for the sellers up here. 10, disappointing. So you can see we traded below 9, but again, better than buying above 9, probably buyers below 9. It's a bad low 1 short for the bears. We still might have to get back to the bar 6 high, but I'm not all that convinced that it's going to be immediately, right? So it's not really worth selling below 9 or, trying to sell above bars, betting that that's what's going to happen. It's probably better just to wait and see what happens and then get in as the market heads back down to it with a good signal bar. 11, an inside bar. You can, I wouldn't buy above 11. It's an IOI pattern, right? So bar 9, an inside of 10. Bar 10 is an outside bar. It did trade to the exact high, but that's a variation of an outside bar. And then bar 11 is an inside bar closing near its high. So it's an IOI breakout mode buy for the bulls. But if you're buying up here, you're buying the top of the trading range, and it could be 1, pullback 2, pullback 3rd, push up. So not really ideal. And 11 is unable to close on its high. If 11 is able to close on its high, it might be a more credible buy because we are always in long. I think we've been always in long since 7. We were probably always in short after bar 1. Even with the gap up, and considering the context of yesterday's close, how far down it sold off, I thought bar 1 we might be back to always in short. But it's not really all that clear until bar 7, where we're clearly always in long. 12, disappointing follow through for the bulls. So if you had bought above 11, it is a follow through bar, but it's closing below your entry price. So if you had bought above 11, you're at a loss right now on bar 12. So even though it is follow through, it's really not all that good. Generally, when you get an IOI, 50% chance that the market breaks out in either direction and 50% chance that the first breakout fails. I think given this, I thought it was more like a 60% chance that this breakout to the upside failed and we started to go sideways instead. Again, doesn't mean we're going way down, but I just thought the context favored more sideways, so it might be more like a 60% chance of failure somewhere up here. And then you get a big outside bar, disappointing bar 13. It's possibly some sort of wedge, 3, 9, 13, something like this. I thought there was a bigger triangle to be drawn. You could say here, or you could draw it probably all the way from up here. And then this was the lows right here. So I thought, while we had a small, we were kind of forming a triangle in the day, really just the range was contracting, but there was a much bigger triangle at play. I know that I drew the one that was like this. I drew the one that was here and here because that one ended up being more important on the day, I think. But I thought, at this point in the day, you can't see that yet. And so I thought at this point in the day, I was looking at the bigger triangle and looking for a breakout of that triangle. 14, an inside bar. It's a high one, kind of a high one buy for the bulls. It's another IOI pattern, 12, 13, 14. But really all this is a tight trading range. When you start looking and you're getting constant IOIs and IOIIs, like we got to bar 15, really the thing that needs to be reminiscing in your mind is the fact that this is a trading range. So it's trading range price action. It's probably better to just wait rather than doing anything. 15, an inside bar, again, IOII, breakout mode. If you're selling 15, the plus is you're selling relatively high in the trading range, so good for you. But the problem is you're selling in a tight trading range, and it's really not all that great to sell in tight trading ranges. You're also selling right on a pretty flat moving average, and 15 is not really a great signal bar. So this is not an ideal sell. We are probably getting back to the 6 high, so maybe some algorithms will take that for a scalp, but it's kind of difficult, and I still do think we are always in long, so I would rather wait. 16, it's follow through for the bears, but again, it's more of a doji bar. It's really not all that good. If you sold below 15, you wanted a big bear surprise, and you didn't get it. 17, another bear bar, but this is really not that ideal. It looks like we're just making a relatively lackadaisical move down to the 6 high. It's possible we test down to the 7 low, somewhere around there, but I don't really think this is all that good for anyone. We're also pretty much smack in the middle of the trading range, and we're probably going to break out of the 18 bar range. At this point in the day, we're almost definitely going to, because it would be really rare for the market to go this sideways. We did something actually today that happens only a couple times a year, maybe once or twice a year, maybe a little more than that, but not much more. And that we broke out, so we had bar 18, and we broke out to the upside of it. Usually when you break out to the upside of it, there's only a 10% chance that you break out to the downside of it. Today, maybe a little bit more because the context was, not, if the bulls fail up here, I didn't think this was going to fail. I thought it was, reasonably likely we ended up getting a bounce. But if the bulls fail up here, maybe more like a 20% chance that we get to a new low of the day after the breakout of the 18 bar range. And then if we trade above and below, there's only like a 10% chance that we trade back above. So it's really pretty rare for us to break out of both sides and then break back out to the upside again. So that's pretty unusual. 18, a bull bar, but a doji bar. It's really not all that good. Again, we're at the apex of this triangle. So some traders are just looking for any good signal bar and they'll take it knowing maybe 50% chance of success, but the reward should be better than the risk. In general, in triangles, 50% chance of the breakout in either direction and 50% chance the first breakout fails, which really should just tell you we're in the middle of a trading range and it's better to wait. I didn't think anything in here was all that ideal. 19, disappointing follow through for the traders who bought above 18. Again, it's going to be more sideways. 20, a bear bar, but it's, you could argue it's a bear outside bar. But to me, for the bulls, it's a breakout pullback. So 18 was your breakout attempt to pull back on 20. And they're looking for at least a second leg up. I would just rather wait at this point. Actually, it's funny. I said to myself that, there's only 2 things I was really willing to do on 21. If 21 was an inside bar closing near its high, it was probably an okay buy. that, or I needed it to be a really big bull surprise in order to buy it. But even the inside bar closing as high would have been good for the bulls because less risk. So the problem with 21 was there was a lot of risk because the bar was big, which is why it didn't end up being as good as it was, or didn't end up being as good as it could have been. But if it was an inside bar, some smaller risk, so maybe more traders would take it. But instead, a huge bull surprise 21. One of the things that I thought was important about 21 is when you see 21, I think we're probably going here. So if you buy above 21, which I thought was a really reasonable thing to do, the first decent stop order trade on the day I thought was 21, and you already had a bull surprise on bar 7. So now you have multiple clear bull surprise bars, bar 7 and bar 21. And when you have multiple clear bull surprises in a day, and you don't really have any bear surprises, it's pretty likely that the bulls are going to do something. And I thought that something would be we're probably going to end up trading up here. Now, a lot of times you can know something's going to happen and it doesn't happen in the way you think it's going to happen. I personally thought at this point in the day that we were going to go straight up to here, or not straight, but sideways to up here. And instead, we got a big downside breakout first and then a good reversal up, and then we went up here. But either way, we're clearly always in long, and we have consecutive bull surprises. At this point on the day, you can see we got a higher low and then a higher high, or you could say this is the higher high, probably more likely. Then we got another higher low, and it looks like we're going to get another higher high. So we're clearly in a bull channel getting higher lows and higher highs. It's not the strongest bull channel in the world because you can see it's more sideways to up, but it is still going up. So most likely going to be some sort of bear flag, but we might have to get some sort of upside breakout attempt. 22, it's follow through for the bulls. It was an upside breakout attempt. 22 did something really important. It closed above the bar 13 high. Now, whenever you get a breakout of something, the strongest thing that can happen is the market can close on its high above that close. Here, we did not close on its high on 22, but we did close above the bar 13 high, which is really important for the bulls, which means that it's more likely that we're going to get some sort of follow through to the upside than it would be had it closed on the close of bar 13. And had it closed below the close of bar 13, it would have been disappointing for the bulls. So probably buyers not too far below 22. And really strong, good for the bulls that it closed above the 13 high, but the obvious problem is it did not close on its high. We're entering into an area where there's a lot of trading range price action, and this whole thing, really, a lot of trading range price action in here. So a lot of times, the big bars with big risk get disappointing when the trading or the price action is mostly a trading range. You can see buyers below 22 during 23, probably for some sort of scalp. We should get back to the bar 22 close is probably the premise of the trade, and they'll buy below and probably be willing to scale in a little bit lower. 24 traded below 23. So 24 is a high one. Bulls want bull trend, 21, 22 breakout, and then 24 breakout pullback. But it's a bear bar, right? So it's harder to want to buy above 24 considering the fact that it is a bear bar. If you're a bull, you wanted some sort of, good looking high one bull bar here. But instead you get a bear bar. 25 is important. I think it was really important that 25 closed on its high. When 25 closed on its high, it made it, first off, it didn't do everything it could have done, right? If it had closed above the bar 22 close, then it would show that the bulls who bought this close and scaled in were not scalping out, and they were looking to buy more and drive the market up. So 25 did not close. It did not do everything that it could have done for the bulls. However, just the fact that it closed on its high is really good for the bulls. It means that there's probably buyers below here. If this had closed somewhere down here, we could easily start to drift sideways to down in some sort of endless pullback fashion. But instead, 25 is able to close on its high, which to me, with this breakout closing above here and a bull bar closing near its high and a couple of bull surprises, increased the odds that we were going to go up to, I thought, where the magnet was. Buyers below 26 or below 25 during 26. You can see, bears would argue it's double top 25, but it's really not all that good. Bad entry bar. And then 27. 27 is a high two, so we have one, pullback, two. The nice thing about 27 from the perspective of taking the trade is the risk is small. It's reasonable. It's not high probability, but it's definitely reasonable to buy above 27 and just put a stop below it and hope we get an upside breakout. The reason is that if we're going to rally, we're probably going to do it now. You can see we're coming to the apex of a triangle, the smaller triangle here. And if we're going to rally during a triangle when we're at the apex and, buying above 21, you knew you might have to allow for a pullback. And 23, 24 was leg one, and bar 26 was leg two. So we already have a two-legged correction. So for the bulls who bought above 21, they said, okay, we got two legs sideways to down. And they look at 27 and they say, well, this is the bulls' chance. So right now, 27 is the bulls' chance to rally. And if it's going to rally, it's probably going to go relatively quick, and we're probably not going to trade below bar 27. So you can just buy above 27 and put a stop below it. I think that's a reasonable thing to do. Granted, again, it's not the highest probability trade in the world because the risk is so small, but it's definitely okay to do that. Disappointing follow through 28. Bulls, I don't know, maybe you can exit below 28, but it makes sense to also just keep your stop below 27. And traders know that bulls will exit below 28 or below 27, so they buy the close of 28, and they end up getting the good bull bar closing near its high 29. 29, strong bull bar closing near its high. I think enough for probably a second leg sideways to up. I thought this was good for the bulls and increased the odds that we break out above the high of the day. Since we had already broken out of the 18 bar range at this point, it was less likely that we were going to get a breakout to the downside like we ended up doing. But disappointing follow through on bar 30. I thought the way I was looking at it was a wedge. So 3, 13, and 22, or you could say 1, 13, 22. Either is fine. But I mean, you could even say 9, 13, 22 if you wanted to. But I think the point is that there's a wedge, regardless of how you're looking at it. And I thought 29 was going to try to break out above the wedge and, maybe 50-50 chance of success. Instead, you get a disappointing follow through bar on 30. If you have to exit below 30, I don't know. Maybe you probably can and look to buy again. But I think that the bulls had continuously done just a little bit. They had just done enough. If you were watching during bar 31, what often will happen is if these bars sell off, 30 is not a good signal bar. So if these bars sell off in the beginning, they'll end up rallying back up above their midpoints and even to their highs. And you can see here in the first minute, we got the big sell off. But when you're only a minute into the bar, a lot of times, the bar will change its shape a lot by the end. So the second and third minute, we actually got the bounce that traders were looking for. However, instead of holding and buying more and turning it into some sort of bull close, they ended up scalping out of their longs, and that caused 31 to be disappointing. I thought 31 was really disappointing, and I thought 29 was kind of the last chance for the bulls. You didn't have to exit below 30, but if you didn't, you got to get out below 31 because that is not what you wanted to see. 29 was the last chance for the bulls. We've already gone sideways for 3 pushes, essentially, 23, 24, 26, and 28. So it's really, if we're gonna get the rally, it's gonna be now. And 31 made me think we are not. So you can see on 32 we have a big tail on the top of the bar. Why? Because a lot of bulls thought that that 31 was not going to happen. So initially they bought the close of bar 31, putting a stop directly below it. You don't have to risk very much, or however much they were long when 32 started to rally. Either way, both those traders just scalped out around the 30 low, deciding that they didn't want to see 31, and so they'll just take the entry. They'll just take the exit around the 30 low with a little bit more information. Some bears will also sell the 30 low after 31, knowing that bulls will be disappointed in how 31 closed and will be willing to exit below bar 31. And those traders, we rallied up to the high of bar 32 about, two-ish minutes into the bar. So there's still like 3 minutes left in the bar for it to sell off. So it's reasonable to sell during that, expecting that 32 will not close on its high. And if it does, you just get out. 33, a bear bar closing near its low. We're breaking out of the triangle. You can see the breakup to the upside had failed. By the triangle, I mean today's triangle, the one I had drawn earlier. 33, a bear bar closing near its low. It's a relatively tight channel down. You can sell for sure, but it might be forming some sort of major trend reversal. And I thought we might have to pull back one more time since 30 is not the best sell signal bar. And, the bull channel up, there was a couple of good bull surprises on the way up. So I thought we might have to get a bounce. So you can sell 33, hoping exactly what happens, but a lot of times you're going to be disappointed. 34, follow through, but it's really not all that good. Big tail on the bottom and disappointing close. 35, more follow through, but again, big tail on the bottom. It's not all that ideal. It's okay to be short right now, but we're probably going to get a pullback soon. And you can see 36, we started to rally, but ended up getting a disappointing bar. Am I selling below 36? I would not. It's an inside bar, a low one short, but a bull bar, so probably more buyers below. And instead, we got a really big disappointing bar 37. Now, 37 is an interesting bar because it has, there are two sides to 37. Some traders will see it as a second leg trap. So they didn't really want to sell in here. And then they got the pullback 36 and then 37, a bear bar closing near its low. So they're thinking, okay, 37, but might be a second leg trap, 1, pullback, 2. And additionally, we're around the 7 low. So there's probably buyers around the bar 7 low. It's such a big bull bar. So we're probably going to find buyers here. Could be a second leg trap. The bears, they think we might have to get to yesterday's low and test at least a little bit lower. So it was reasonable. I didn't really want to sell 37. I didn't think it was a very good sell. just because the bar was so big. So now the risk is big and you're selling low in the trading range. So again, big bar, big risk, low in the trading range. Not really all that ideal. There's probably buyers below here. But I think the bear's argument is that we're trying to get below yesterday's low and trigger the sell signal bar on the daily chart. And we get a big reversal up on 38. To me, 38 solidifies this is a leg in a trading range. The channel is pretty tight, but to me, it looks a lot more likely that after bar 38, we're going to get a reversal up. I thought you could buy above 38 with a stop, maybe a measured move plus a little bit. I usually, if I do this, I usually use a measured move plus a couple ticks. I might have gotten stopped out here, but if I did, first of all, I didn't take the trade. Had I taken the trade, I probably would have used a measured move plus a few ticks. So potentially gotten stopped out here around the low if I did. But you got to buy again above 44 if you do that. So 38, bulls see a lower low double bottom. You can see we traded below bar 6, which is important on 38 that it's a lower low double bottom because that means we might have to go sideways down for one more leg before we get the reversal up. With how tightly down this channel is and the fact that it's a lower low double bottom, the odds of us going a little further down are increased. Also, the micro gap down on 39 is not what you wanted to see. You wanted to see a small gap, up, if anything, or it just open around the close. And instead, you get 39, big outside down. Probably buyers below 39 scaling in lower, or below 38 scaling in lower, but disappointment on 39. 40, a reversal up. Tried to become a midday reversal, but a bear doji bar, so not all that good. Probably sellers not too far above, but probably buyers not too far below. 38 was such a strong looking reversal bar that I think we are getting back to the bar 38 close at some point today. And then 41, bear bar closing near its low, but good for the bears, yeah, but why does 38 exist? Why is 38 such a strong bull bar if this is going to be a bear trend? You have to ask yourself that. You could be selling a second or a third leg down, so it's really not all that ideal to sell below 41. If you are selling below 41, you have to think about what you want to see. What is the premise of your trade? The premise of your trade is that the bulls who bought above 38 are just going to end up getting trapped pretty much, and that this is a bear trend and that we're going to start to sell off. You can't get bad follow through. You can't afford bad follow through. So when you get the bad follow through on 42, bears are going to be willing to exit above 42, a midday reversal, and a very credible buy above 42. And instead, we trade below it on 43 and bulls buy below bar 42 instead. Now, for me, if I sell 41 and I see 42 and 43 gives me a break-even gift, I would probably just take that as 43 is trading down. Because now, look at 42. So you have 38, a credible signal bar, a really good-looking bull bar. Now you have a second reversal up 42. So you have two really good-looking bull bars. This is probably going to be a leg in a trading range. I do not think the sell-off is going to go very far. So you can see there were buyers below 42, buyers at the low of the day, and buyers around the 41 low, and that's what caused the reversal up on 44. 44 midday reversal, best trade of the day. Very okay to buy above 44, put a stop below, and just go on a walk for a bit. If you're buying above 44, your premise is that you've seen the low of the day, and it's a really good bull bar. We're at least getting here. We had a couple surprises earlier. It's possible we get here, and if we get here, we might have to get here. So credible to buy above 44, maybe take a little bit off at the open of the day or the high of the day, and then here. So just take the buy, put a stop down here, and do something else for 20, 30 minutes, and then come back and see where we're at and reassess. Good follow through for the bulls, 45. So lots of buyers above 44, relatively expected because I thought 60% chance that we at least get a couple legs sideways to up here. So I was really not all that surprised when we got a pretty strong rally. Again, follow through 45, really good looking for the bulls. It's closing below the moving average. You can see there were some sellers around the 38 high when it got there during 45. The traders who bought above 38 and scaled in lower. 46, an inside bar. It's a high one for the bulls, but a bear bar. So disappointing. Probably sellers not too far above, but the context is still pretty good for the bulls. So I still think we might get at least another leg sideways to up. And 44, 45 might be strong enough even for 3 legs up. So we'll see. Additionally, you're low in the trading range. Anytime you get the opportunity to buy a really good-looking bull bar, 46 or 44, low in the trading range, it's probably going to be pretty good. This is overall an expanding triangle. You can see what it ended up being. No. But overall, an expanding triangle. 47, it's a double top with 45, but probably buyers not too far below. It's a bull bar. This channel up's moving pretty tight. 48, really strong bull bar, closing near its high. Good for the bulls. Probably going at least a little bit higher. And this itself is strong enough for its own second leg sideways to up. 49, a bear bar closing near its low. So it is 2 legs up, 44, 45, and then 47, 48. but 49 really isn't all that great. And this channel up is really, really tight. So you got to also keep in mind, there's a lot of bars left in the day. There's, 33 bars left to the day. So what are we going to do for the next 33 bars? Are we going to go sideways? Are we going to go down? Or are we going to go up? I don't think we're going down. I think the bulls have proven that with how strong 44 and 48 are. We might go sideways, but I think this channel up, even if we start to go sideways, this channel up is tight enough that we're probably going to at least go a little bit higher. And the reason for that, let's just go to bar like 50. And let's look at a 15-minute chart. Look at this on a 15-minute chart. There's a pullback, yes, but these are consecutive bull bars. So if you look at this chart, you think even if we go down a little bit, we're probably going to still get a bounce. And that's exactly what traders were thinking. So, well, yes, it's a bear bar closing somewhat near its low on 49. The channel up is tight enough that we're going to get a second leg up. The reason a tight channel is important and will get a second leg up is because the higher time frame is a breakout. It's a breakout on a higher time frame. So a tight channel, when you see a tight channel, think higher time frame breakout, probably second leg. 51, a bull bar, but a tail on the top. We're probably going at least a little bit higher, but I'm not sure. We're probably going to break out of the high of the day. I thought, the open of the day would be a target, the high of the day would be a target, and this would be a target. We ended up reaching all three. Follow through for the bulls, 52. You can see some traders started to take profits around the open of the day. So we got doji bar 53, a doji bar 54. It's an IOI, so 52 inside of 53, and then 54 inside of 53. So it's an IOI breakout mode pattern. The theoretical sell below 54, but it's not good at all. It's a terrible sell. Probably buyers below, like 60% chance at least that this fails and we get another leg up. And that's when you get disappointment 55 or 56. Sorry, 55. And then a bull bar closing near its high 56. So follow through. 57, a huge bull bar at one point, but ended up getting a big tail when we got towards the high of the day. So traders are exiting. Traders might be looking to exit pretty quickly here, except for the fact that, like I said, we have a magnet up here. 58, an inside bar, a bull bar closing near its high. It's a high one. You can buy, but this is just climactic. So if you're going to do it, you got to realize you're buying a pretty climactic move high in a trading range. So you got to have a, pretty, probably a stop below here. I don't know if you can just put a stop below 56, 58. But if you're going to be buying up here, you got to realize it's going to, go against you relatively often. If you bought up here, you get 59, which wasn't the best follow through with the huge tail. But you can see bulls bought the pullback. So they were buying the pullback of 58 rather than buying above 58, which isn't all that ideal. But bulls see, it's still consecutive bull bars. It's still a tight channel up. Still buy the close. So we get a big surprise on 60. If you're long for any reason, we've reached all the magnets. Probably just makes sense to get out on the close of 60. And if 61 is another bar that looks like 60, you get back in. 61, a bear bar closing near its low. 60 would have been a better magnet for the bulls had we traded above 60 and trapped some bulls before reversing down. But it's still, 60 close is still going to be a magnet for the bulls. And this channel up is so tight that the reversal down here is going to be minor. So it's a minor reversal. We're probably going to get bad follow through. But what are you selling for if you're selling 61? You're selling for a second leg down. So bad follow through on 62 is not surprising. If you sold 61, I would probably just stay in on 62. Probably sellers not too far above after the surprise on 61. And you can see you get a disappointing follow through bar 63. And a big second leg down 64. So 1, pullback, 2. So that's 2 legs sideways down. And 64 was a surprise. To me, if I see 1 and then a pullback and then a big second leg sideways to down that's closing around the moving average, I would just get out on the close of 64 or during 64 is even better. It doesn't matter, if you got it. If you see this, you thought, oh, well, I wish I'd gotten out down here. It's fine. If you sold 61, you did a reasonable thing. You were selling for a second leg sideways to down. You get better than 2 to 1 at true risk, and now you have your second leg sideways down. Sorry, better than 1 to 1 at true risk. I assume it went for something like 2 to 1 at true risk. Something like it, yeah. So I would just get out on the close of 64. Disappointment 65. You can see buyers below 65 most likely. 64 might get a second leg sideways to down, but 66 is the second leg sideways to down. That the close of 60 is going to be a magnet for later today. Not sure how fast we'll get there, but we are probably going there at some point. Disappointing follow through 67. I wouldn't buy 66. You probably could at the high 2, but I don't know. It just seems like the risk is big and it just seems like an iffy trade. But I do think we'll probably get back up here. Disappointment 67, and then you can see we started to go sideways and then ended up breaking out to the upside. This is not buy the close to me. 71 theoretically buy the close, but I don't know. I just think lots of overlap, and this is the target, so it's hard to buy up here, right where the traders will be selling. And that's why you end up getting such quick disappointment, 73, and then we go sideways. For stop orders on the day, I thought 21 was the first okay one. I thought 27 was fine. And either way, probably get up below 31. 33 is fine, but tough to take, expecting a pullback, but reasonable to do in case you don't get the pullback and then you just exit above bull bar closing near its high. I probably would not buy 38. I'd rather wait, but it's not the most unreasonable thing with a wide stop. You can buy above 42 during 44, or just buy above 44, and it becomes pretty much, by the close 48. You can buy above 56 if you want, or 58, but again, getting high in the range. Might be 3 pushes up. I thought 45, 48, maybe 50, 53, some sort of wedge, and some sellers at the open of the day. So a bit tough. And that's pretty much all I would do. You could sell 61 if you wanted to for a second leg sideways down, but you got to be a good enough trader to decide to just get out here and be objective about it rather than hope, we get a collapse to the downside. But to me, I think, well, scrolling out, this is all probably going to be big trading range. We got the big rally to the upside, as you can see, that we had gotten for a while. And we've pretty much just been sideways for this many bars. This is looking like the bottom of the range. This is looking like the top. Maybe this is the bottom of the range. Or I guess that's not actually a big gap on the continuous chart. Let me just pull this up. So either way, you get the rally. I think that it's a weak bear channel, but it is a bear channel. And we're probably, you can see it from here, a weak bear channel, but still a bear channel. It's this is a major lower high. This is a major lower high. So we'll see if we can get above either one of these. In order to break out of this bear channel, we need to get above, this lower high, I think. We might be trying to form another one here. So bears want us to get a turn down, and bulls are hoping we break this trend line and get up to this magnet. One of the reasons it's a magnet is a lower high, yes, but you can see so many straight by the close bars, and they never had a chance to get out. So it's not unreasonable to think we're going to go here later this week. The daily chart, IOI pattern. So inside bar, outside bar, inside bar. It's a breakout mode pattern for the bulls. Are we gonna race up above this breakout mode pattern? I would say, I don't know, 40% chance that we just, end up getting a big bounce. We might have to get above this high, but I'm not all that sure. I wouldn't be surprised if this failed. So let's just put it this way. I think it's going to trigger, right? So if we, I'm assuming tomorrow we open somewhere around here. That's just my assumption for what I'm about to say. I have no idea where we're going to open. But if we trade above yesterday's high, I would pay a lot of attention to if we get an explosive breakout or start to fail, because a failure from above yesterday's high would make sense for that trade. The weekly chart, I guess it's the beginning of the week, but let's look at the monthly chart. Really good for the bulls. I don't know if it looks different on SPY. Probably not that different. Yeah. I'll just look at it on this though. Really decent month for the bulls. The bears, this is their last chance this week, and they're going to try and put as huge of a tail as possible on this and make it close below its midpoint. So the midpoint of this bar will be important later in the week. Bulls are trying to prove it's a small pullback bull trend with open gaps, and bears are trying to prove it's a trading range. So yeah,